Hi, I'm Pattu from freefincal. ICICI Prudential ESG Fund is a new fund offer from the ICICI Fund House, and its NFO period starts today. So let's take a look at what the ESG investing theme is and whether you should invest in such funds. Now, before I begin, I want to point out that those who have signed up for my course on how to get paid for your skills, their email for the payment and all the course details will be sent out only on the 1st of October. The payment link for the rupees 2000 payment link would be sent out only on the 1st of October. I have already made a video on the course contents, what you can expect from the course and all that. You can see that in the previous videos from the channel, or you can go to freefincal and look at the feed. I have started shooting the videos for this, so I expect about 20 a minimum of 20 videos in the course, and by the time the course starts on 1st October, my plan is to have at least 50% of the course ready, and as you consume the 10 units, I will be adding more units to it every day. Each one day, one unit is my plan. And so that's that. I had one more, yeah. So a couple of days ago I had made a short video on asking you to post questions. I had about 150 questions or so, a lot of questions. I've been trying to answer all the questions. I'll be doing that gradually. I've not forgotten that. So if I've not answered your questions, please don't take it badly. I will get to your questions. Sorry, I have too many things to sit and focus on. So I'll get to your question for sure. All right. So let's get to this. Notice that Quantum had a ESG fund launch about a year ago, maybe. Axis has a ESG fund. SBI has a ESG fund. Everybody is getting onto this ESG thing. So what is this ESG? ESG is basically environmental, social, and governance investment team. That is, you pick a stock which which is environmentally conscious, which has got a social responsibility, and it has got good governance, and it has got good corporate governance, as they call it. So basically it's like saying I want to invest in a team that takes care about the environment, that takes care of the society, and that's got good corporate ethics and so on, so that it basically there is no risk to the company. It will not get into any kind of controversy. It's an ethical company, and also because it is not doing damage to the environment, which is the opinion, then you think that government regulation will not affect it in a major way. So basically the idea is that if you invest in such companies, you are likely to get better risk adjusted returns. Is that really true? Is a very, very I mean, debatable point. See, the point is, okay, I've given you several examples here. For example, you can see environmental empathy means companies which take into account efficient waste disposal, cognizant of climate change, pollution, energy, water conservation, etc. Social responsibility means company management, gender equality, women empowerment, labor welfare, contribution to social causes. Corporate governance refers to business with ethical practices, efficient management, absence of fraud, illegal action, and so on. The NSE has got three such ESG index funds. Would you believe it? That they've got one basic ESG, then they got an enhanced ESG, then they have a ESG sector leader, which is bizarre. It's really bizarre. Now, if I choose stocks based on low volatility or even based on alpha, I am using a quantitative measure. I know a formula. That formula will have some assumptions because alpha will have a risk-free rate and so on, which is fine. As long as you are reasonable in choosing your risk-free rate, you are okay with it. Low volatility does not even have any that kind of assumption. As long as you understand that you are taking standard deviation of daily returns, you have some set quantitative framework. You take the stock price, feed it into that framework, and whatever gets out, you basically list them, and you are able to get stocks with low volatility, high alpha, high quality, high value, or what should I say, correctly priced, whatever it is you want to call it. That's a quantitative measure. Now, if you want to say I'm going to choose a company which is very high on E, S, and G, that becomes an opinion. It becomes a qualitative assessment, and it becomes an arbitrary thing. I can sit and argue it is not. For example, supposedly alcohol and tobacco are supposedly sin companies. Gambling, they are sin companies. I will argue that if I produce sugar and feed them to population, or if I'm a fast food company, that is also a sin. I'm also committing a sin. I'm also committing a social sin. I'm making people obese. I've already talked about how eating sugar is basically the same as consuming alcohol, so that's as much as a sin. So, and if I'm a dairy company, people will say you are it's a cruelty to cows. So, what is a sin and what is not a sin is an arbitrary notion, and this is bizarre to say the least. And I mean, I don't know how it will even hold water. Okay, whatever they have some ESG metric, ESG risk factor, controversy number, all sort of lingo is there when you look at the NSE methodology, or if you look at the ICICI fund ESG fund scheme document, not the scheme document. Scheme document will have not much. The presentation document, but the point is, does it even work? So even if it is arbitrary, by the way, before that, these are the 10 stocks out of 88 stocks in the Nifty 100 ESG index. Reliance, HDFC, Infosys, HDFC Finance, Housing Finance, TCS, etc., etc. Now, are these really the best socially responsible, environmentally friendly, ethical firms in India? Really? You can sit and you can pick any of these funds, any of these companies, and start debating on that. It becomes a debate, and that's not how investing should be done. This is the same problem I have with balance sheet analysis and so on. One person will say this is right. It's like blind people touching an elephant. I just abhor that. It's just makes no sense. Alright, so this is the comparison of the Nifty 50 in black, the Nifty 100 in green, then there is a Nifty 100 enhanced ECG, whatever, I forgot what that means. I think they have, the enhanced ESG means the ESG score should be above 50%. So it's like the cream of the ESG crowd. But look at the difference between the red line and the green line. That's barely any difference. And notice here, when the market was in sideways, that is between 2009, after the market recovered, when the Manmohan Singh government got re-elected, and late 2013 when the market started moving up, between those 4 or 5 years, it was kind of range bound. During that range bound market, you can't see any difference between the three indices. And this is Nifty 50, Nifty 100 enhanced ESG from the date of inception. Whatever, it's the same. The message is the same. I don't care. If you look at the 5-year rolling return, notice that the white is the Nifty 50. The other three are the other three ESG indices. First of all, what is the need for three indices when all of them are giving the same, more or less the same returns? It beats me. Over 5 years, it beats me. Second of all, notice that when the bull run stopped in January, February 2018, then you notice all the lines fall on top of each other. The extra benefit, whatever you got from ESG, vanished when the bull run is gone. So only when there was a bull run, these companies got better price movement and they got better returns. But point is, this is the market which decides the bull run. Does the market actually sit and think about E, S and G when they buy stocks and when the price moves up? How do you know the returns that the extra returns that these indices got, that these stocks in the ESG indices got, came only because of your ESG, E and S and G factors? Nobody can tell. That, like I said, it's just arbitrary. Please avoid such nonsense. Please don't take any kind of thematic funds. These AMCs will introduce thematic funds because SEBI has given them the freedom to launch any number of thematic funds under the new scheme categorization rules. So they will keep doing all this sort of mumbo jumbo. Please avoid. Bye bye.